Hello, everyone. Happy New Year. Happy 2023. And welcome back to Hard Money Jim on the ARCUK YouTube network. Today, I am operating in winter quarters from beautiful Coronado, California, where premium gas is still $7 a gallon. But the sun is mostly warm and wonderful out there, except for this week when we got a little bit of rain, which we do badly need. Let me share my screen here. And I'll give you a quick look of where I am. That's a shot of Point Loma from the beach, very near home here. Looks a little out of focus there, but you can see all the sailboats out. I hope you had a great holiday season, as I did, spending time with family and good friends. In the coming year, I plan to continue these podcasts and essays, but I want to publish more consistently. So to do that, I need time to prepare these presentations to the level that I think you want. So rather than try to do a podcast every week, as I attempted to do sometimes last year, I'm going to shoot for every other week. There's no guarantees on that because I have other projects I'm working on, but a podcast every other week will be my goal and my intention. And along the way, I plan to write some additional essays as well. Now, the good thing about our main subject, money creation and its consequences, is that we'll never run out of good material to talk about because money creation shows up everywhere. It affects all financial decisions, and it's not well understood. Today, I want to discuss a very important consequence of our government's unsound monetary policy. And I'm speaking of the ballooning federal debt. And how that debt is affecting you now and how it will affect you in the future, in the coming years. The huge size of our federal debt is a consequence of money creation because the government, by manipulating the banks and the Fed, has been able to borrow money from the public almost without limit and pay off its debts or pay its interest with new made-up money and cheap interest rates. My aim in these next three podcasts, this three-part program coming up here, is to explain first what is happening with government debt and the problems that it presents to U.S. elected politicians. Then second, how our politicians are going to deal with that growing debt problem. That is, how they're going to react to the debt problem, which is a problem of their own making, of course. And finally, how the government's emerging monetary policies are going to affect your financial life and what you can do to protect yourself against financial damage. That's my goal. So today I'm going to be covering part one, the unpayable debt. I want to discuss the enormity of the U.S. government's debt and why it cannot be legitimately paid off in the same way that you and I have to pay off our debts. And I'm going to make the case that the U.S. government, and really all major sovereign governments really, is approaching a point where its traditional methods of gathering money by taxing and borrowing in order to keep their political promises, that's not really available to them. It's not going to be. In other words, traditional taxing and borrowing have hit an upper limit. So further funding from these channels of money is going to soon become impossible. And that's why I titled today's podcast, Uncle Sam's Unpayable Debt. Then in part two of the series, that'll be 2 weeks from now, I'm going to cover, that'll be January 27th. That'll be about how the government is likely to react as it approaches the point of being unable to pay its debts, to pay it for its promises. And in preview of that, not to get too far ahead of ourselves, the government is going to use a variation on the same tricks and techniques they've always used to stay afloat. But their tricks are going to come in a slightly different form, and therefore they're going to be hard to recognize, if you're just a normal human being, who doesn't have time to analyze money in banking. And you will not be surprised to hear that these emerging policies are not going to be beneficial to you. So I'm going to call that part 2, money creation, the disease and the cure, because irresponsible money creation is a major cause of our debt problem, but it's also going to be a part of the government's proposed solution. That's going to be a policy of financial repression, and they're going to try to use that to get out of their debt trap. And then finally, in part 3, which is scheduled for February 10th, after we understand the government's funding problem and understand how the government is going to try to fix its problem, we'll examine how its new policies are going to affect you. Part 3 will hopefully be your cash value for sticking with these podcasts, because we're going to discuss what you can do to mitigate the effects of these policies. That is, how to fight back to survive and perhaps even prosper in this coming era of financial repression, which may be with us for a long time. Okay, thanks for your patience with that long introduction, but I think it's important for us to know where we are going and where we are at all times on this little discovery tour. As always, please keep in mind that it's much easier to understand the challenges ahead if you have some fundamental knowledge of how money is created and how the government tries to control the money creation process. And if you subscribe to Hard Money Jim for free on Substack, you'll find plenty of short essays explaining how money creation works and how government frequently abuses that process. So now let's dive into today's subject and talk about Uncle Sam's unpayable debt. Okay, to begin, my thesis is that U.S. government debt is so large it can never really be paid off, at least not legitimately, and I'll explain why I think this is so. Back in 1977, Margaret Thatcher famously said that the trouble with socialism is that you eventually run out of other people's money. I might have cut off part of that quote there. Eventually, you run out of other people's money. Now, whether you like socialism or not, that statement is true, because the fact is, if you keep taking wealth from productive people to give it to unproductive people, you're eventually going to reach a limit on the wealth that you can redistribute. Thatcher's phrase here is pretty insightful, but even it understates the problem of other people's money, because what she had in mind is that the government has taxed people to their limit, and that the limit on taxation is therefore the limit on socialism. And that's what a lot of people think, that socialism or mandatory wealth distribution is simply taxing Peter to pay Paul. But taxation is just one of the ways government can redistribute wealth. Taxation is the most visible method, and therefore it's the most honest way to gather and spread public revenue. But there are also less visible redistribution techniques, including taking on too much government debt and paying it back with depreciated currency, which penalizes lenders and benefits borrowers. Now, I'm going to make the case that we are running out of other people's money, whether you are talking about taxing or borrowing. Our government has taxed and borrowed so much that the ability to gather any significant additional government revenue has reached a kind of boundary, a kind of a new frontier. Now, I'm not talking about the legal limit on the funded federal debt that Congress haggles about every year and that they're haggling about now, but about the unpayable future obligations, the future obligations that are ultimately going to require an important change in our monetary system. So let's dig into this. Here in bullet form is the basic structure of how our government continually takes on more and more debt. Politicians make promises to voters in order to get elected and stay in office. And to fulfill these promises, they throw public money at social problems, either real or imagined, by taxing and borrowing. For example, politicians promise to wipe out poverty or stop the seas from rising by spending hundreds of billions of dollars of public money. Now, this process keeps them in office, because promises and throwing money at problems is popular enough among voters to get heavy spending politicians reelected year after year. But this cycle of promises and spending eventually requires that the government grow the cost of its promises faster than it can gather revenue to pay for them. First, they tax individuals and corporations, raising taxes as high as the voters will allow. And when they run out of tax money, they borrow money from savers and investors. And then when they can no longer legitimately borrow money from savers and investors, they resort to unproductive money creation, also known as inflation. Now, here for you is a familiar chart of the broad US money supply. We've talked a lot about this in this forum, along with the techniques of that both the Fed and the Treasury have used to create money for the government's benefit. The leading example in recent history is the period from 2009, right here, to 2020, right here. That's 13 years of quantitative easing, in which the Fed commanded the banks to create an unprecedented amount of new money, which then funded the federal deficits by lowering interest rates and monetizing a large portion of the government's debt. That policy culminated up here in what I call pandemic QE. That's the wave on the right side of the graph, which fueled the asset inflation blow-off and also the consumer price inflation that we are still involved with today. So enabled by QE, our politicians have run up a huge national debt. But how big is this debt? There are several measures that you could use to measure it. For example, the debt clock here, up here in the upper left, you can call this up, by the way, and it's a real-time debt clock. This is from a few days ago. The debt clock here shows that the absolute level of what is called the funded debt, or money borrowed in the public market, is over $31 trillion. That's with a T. There are also measures of per capita debt, to give you a sense of how much sovereign debt is somehow borne by the average citizen. So that per capita number in the USA now is $94,000. So suppose the average US citizen was asked to pay off his share of the existing national debt. The median personal income of Americans is about $36,000, each individual American, not households. So the debt per citizen, for that citizen, is about $94,000. How long would it take for the average earner to pay a debt off that large? You tell me. If he could cut his consumption by 10%, it would still take over 20 years to pay off existing debt, not including interest. And that sounds pretty unrealistic to me. Now, here is a chart of the growth of the national debt, the total national debt. Uncoincidentally, it looks very similar to the previous chart of money supply growth. But let's focus on the rate of growth of this debt in increments. US government debt grew at an average of 9.2% a year from these years, 2000 to 2008, 2001 to 2008. Then from 2008 to 2020, those are the big QE years, national debt grew at 12% a year. And then during the last two pandemic years on the far right, it grew at 17.7% per year. Obviously, that is not a great trend. If you put it another way, in the first, since 2000 here, the first 22 years of the 21st century, US government debt grew 445%, while GDP grew only 260%. All right, just trying to get an idea of the size of this monster. This chart shows the ratio, of federal debt to GDP which has grown from a rather modest 30% back here in 1980 to over 120% today. That's about the same ratio as the UK's GDP, debt to GDP has grown as well. And you can see the spike in debt to GDP during the pandemic years there on the right. Now, this debt to GDP number is the most popular and widely quoted measure of the debt burden. GDP is roughly a measure of all national income, both to businesses and individuals. So debt to GDP is similar to you measuring your total personal debt against your total personal income. So if your annual income, say, was $100,000 and your total debt was a $10,000 loan with an interest rate of 10%, that would be annual interest payments of $1,000. Your lender would probably say you're a pretty good credit risk for more lending because your debt to income ratio is only 10%. That's 10,000 divided by 100,000. And the ratio of interest charges to income is only 1%, 1,000 to 10,000, okay? But if your debt went from 10,000 to 200,000, say, more than twice your income, your debt to income ratio would go from 10% to 200%, and your interest expense of $20,000 would bring your interest expense to income ratio from 1% to 20%. And any lender would think more than twice, I think, before lending you additional money. Because if your income is $100,000, it's very unlikely you can afford $20,000 in interest payments. So $31 trillion in debt is a big number, and you hear it mentioned a lot as Congress does its annual kabuki dance of arguing about the authorized debt ceiling. But large as that is, the 31 trillion is only a minor part. It's a minor part of the US government's real financial obligations. 31 trillion is what the government owes to current owners of treasury bonds. This is the government's funded debt, meaning that this money has already been borrowed. But there's a lot more unfunded debt out there. And although no one knows its exact number, it is very large. And it brings the government's real total financial obligation to at least $100 trillion or more. Now, I want to explain this unfunded debt and show you how to estimate it so you have confidence that what I'm saying is true. So start with the existing debt, mostly out there in the treasury market, 31 trillion, which was the number we saw on the debt clock. Remember, this funded debt is money the government has borrowed in the past to pay for things that taxes could not cover. It's already been spent. It's 31 trillion already paid out in government spending. Now, next, consider the unfulfilled promises that the politicians have made for the future, mostly in the form of promises to pay entitlements. These are things like Social Security, disability payments, Medicare, and Medicaid. And they're generally around 70% of our total annual budget. They're real promises with real cost of living escalators built in by legislation, but they're not yet funded, meaning the government has not yet taxed anyone or borrowed from anyone to pay for those obligations. So how this is a depiction of what those deficits are. You can see the $3.2 trillion deficit in 2020. Unbelievable. Here is a historical chart of these unfunded obligations. These vertical bars are the annual deficit. And they're paid by borrowing the difference between what's required by law to be paid out and what can be collected in taxes. The difference between tax revenue and required payments is called the federal deficit, and it's funded by the additional borrowing that we know the government will incur every year. As you see, these deficits will continue to be very large. The Congressional Budget Office, which has a history of underestimating deficit spending, projects big deficits as far as the eye can see, and their projections go out about 30 years. Now, please note, this kind of deficit is very different from other famous deficits from past history. For example, To pay for World War II, the USA and many other nations borrowed huge amounts of money, way more than they could raise in taxes. But this borrowing financed planes and tanks and soldiers' wages, which had a finite life, a finite purpose. They were one-time costs. So when the war was over, we scrapped the tanks and the planes, and the soldiers went back to work. And so these war debts were finite debts with a one-time deficit that was paid off pretty quickly. But our current annual deficits, the ones you see here, are quite different because they're chronic in the sense that they're trying to fund an open-ended obligation to pay retirement and medical benefits to every citizen, everyone alive and everyone yet unborn until the day they die. So they're imprecise and open-ended obligations with no known limit, but they're very real. So the next question becomes, how do we put a current monetary value, a present value, on these future deficits that we know will occur? Now, I'm now going to show you a shorthand method included free today for your tuition. In financial terms, what we're going to do here is estimate the present value of future deficits. So current annual deficits are running about $1.5 trillion per year. That's the average of the last 10 years. And that is a conservative estimate of future deficits. So let's assume that this 1.5 trillion deficit repeats every year for a long time into the future. The question is, what would it cost to make this a funded liability? Let's imagine that the amount of money the government would need to invest today, what is the amount of money the government would need to invest today in order to pay out 1.5 trillion annually in profit or interest in the future? In other words, it's got to be an investment that would pay for the future deficits, which, remember, is the government spending obligation that is not covered by tax revenue. So let's imagine a huge investment that yields 5% in interest every year, and we need an investment that returns this 5% and pays 1.5 trillion in annual interest to pay for the future deficits. So 1.5 trillion divided by 5% is 30 trillion. So a $30 trillion investment that yields 5% will pay for the annual 1.5 trillion deficit, if you can continue it forever. Now add that 30 trillion to the 31 trillion in funded debt, and the total is a real debt of $61 trillion. That is a quick back of the envelope calculation of total government financial obligations. But wait, that number is still too low because it assumes a constant deficit of 1.5 trillion per year, but we know those deficits are going to grow every year. So let's use a little math trick from Finance 101 to estimate the present value of the growing future deficit stream. So I'm just going to, do the calculation and not derive it for you. It just reverse engineers a compound interest calculation. It really is a complex, and you can find the explanation in any finance textbooks if you want. It's also called the dividend growth pricing model. But let's say the deficit grows at just 3% a year. And again, that's a very conservative number because it's been growing much faster than that. The formula for calculating the present value of the future income stream from our mythical investment that's going to fund all this is this equation: present value equals dividend or deficit divided by the rate of return minus the growth rate of that income stream. All right. So you can go through that and see it. I won't repeat everything, but when you do it that way and account for the growth in the income stream, the present value is actually 75 trillion. And that's with conservative assumptions. Plus the 31 trillion in funded debt gives us a total US sovereign debt obligation of 106 trillion, which kind of makes you take your breath, stop and take a breath, right? So I should stress that this is only a ballpark approximation based on some rough assumptions about future interest rates, investment returns, the growth of deficits, and so forth. More than anything, this exercise, present value exercise, illustrates a method for investing the value of financial obligations. And you can find other similar estimates like this one shown here. None are exact, but now you have seen the basic estimation method, and I hope you understand that it's reasonable. But although it's only approximate, this kind of huge number can be very instructive, because right away, I think you can see this is an impossible investment. It's impossible. Can you imagine the possibility of actually funding this year a $75 trillion investment? There is no way it could be done. 75 trillion is about 3 times the annual US GDP, and it's over three times the broad US money supply. Even compared to the entire world, today's entire worldwide broad money supply is only about 100 trillion, and the global GDP is only about 120 trillion. I mean, there is not enough investment money, and there are not enough investment opportunities even available to fund this kind of obligation. So right there, you can see why these future obligations, future liabilities, have to be, quote, unfunded. They're unfunded precisely because they cannot be funded. You cannot borrow enough to legitimately fund these liabilities, because the excess wealth required to fund an investment of that magnitude does not exist. So the government spending program reminds me of the nuclear fusion problem, because it assumes that the economy is a system that needs to consume more wealth than the system can possibly produce, can put in. So government spending is also almost all consumption spending, not productive spending. And as this consumption spending grows, it eventually consumes everything that the productive side of the economy can produce and gives nothing back to the productive side of the economy for reinvestment. So it's not sustainable. Now, it should be obvious that these huge numbers if they're going to be paid out, the only way they can be paid out is if there is a lot more money created to pay out. In other words, these debts, if they're going to be paid, have to be paid off in inflated, depreciated dollars. So 20 years from now, for example, you might get an annual Social Security check of $100,000, but it won't buy any more than the typical $20,000 buys today, and it'll probably buy less in terms of real goods and services. Now, some conservative politicians and pundits, in warning about this problem, like to talk about a huge federal debt by using phrases like the debt bomb, in which somehow the debt gets so high it reaches a flashpoint and then it explodes, destroying everything around it. But that is not a good analogy, in my view. What we are really facing is more like a debt swamp, where you walk in and slowly get bogged down and dragged under, and then you drown slowly in the quicksand. And it's very hard to identify the specific point at which you were doomed, the point at which there was no going back. So your awareness of this kind of big number is instructive, but it doesn't help much if you want to know how this growing debt is going to affect you personally. I mean, they're abstract to the point of being almost unreal, like saying the star Betelgeuse is 425 light years from the Earth. It's that main purpose is to illustrate, the main purpose of these numbers is to illustrate that the government's financial obligations are much higher than the current national debt, the funded debt. But what does that exactly mean to you? And most important, I think, these numbers don't mean much in the real world because we don't control it. The politicians are in control, and politicians do not think in these terms. To know what the politicians are going to do, we have to ask, how do they think about funding the government? And how do they approach the problem? And that's what I want to cover in the second half of this section today. But let's, before we do, let's pause briefly. And let me look at the chat session. I don't look, I have, do you have anything for me, Daniel? Any questions that have come up?
We have a super chat from Jonathan Honig for $2. Thank you so much, but no questions so far.
Thank you very much, Jonathan. Happy New Year. I wish you the best on your broadcasts, both Fox News and otherwise. Okay, so let's get into now what I think is the best way to look at federal debt, which is the way the politicians look at it, because it's going to tell us how they're going to approach the problem. Now, I apologize for repeating something you already know, which is that politicians think and act only in the short term. Short term means this year and maybe the next election. When they think of funding the US budget, they don't care about these large aggregate numbers that I've been talking about. They think in terms of year-to-year cash flow. And that the pragmatic question that they ask themselves is, how am I going to raise money this year and next year to pay for the promises I made so that I can keep my job, so I can keep my salary, can keep myself in power, get reelected? Okay. So here, go forward here, is how politicians think about federal spending. This is their simplified cash flow format, which we're now going to use to discover how the politicians will scheme to keep their promises in the face of an impossibly high debt level. So under cash requirements on the top there, politicians need money to fulfill their promises and to pay the interest on existing debt. The promises include government expenses like courts and police and other basic government services like national defense. And then there's the whole regulatory apparatus that needs to be paid for, and lots of employees to pay. But most important, as I've mentioned, from a monetary standpoint, are the big and growing entitlement programs like Social Security, Medicare, Medicaid, disability, and so forth, which account for 70% of government spending, and they also account for most of the mandatory future growth of that spending, and that includes all the projected deficits I've just talked about. So I want to stipulate that as they run into cash flow constraints, our politicians will be very reluctant to renege on their promises, as that would be political suicide. So I take it for granted that they're going to find a way to pay for their obligations, most of them, especially the entitlements, at least in nominal terms, in nominal dollars. I'm saying that payouts to voters will not be seriously reduced, except maybe to the voters who don't matter. So, for example, they may reduce Social Security for rich people, but that kind of thing. But this is not going to make a big dent in the budget. Basically, I'm saying politicians do not want to be known for reneging on their promises. That is political death. Okay. Now, they also have to pay interest on the funded debt. That is interest on treasury bills and notes and bonds. They have to pay for that or they can never borrow again. So, and of course, they pay for all this by taxing and borrowing, and taxing as much as they can and borrowing the rest. So this is simple, but it's the thinking formula that democratic governments use to fund themselves. And so to anticipate what our politicians are going to do, we should use this format too. So let's look now at the government's cash flow dilemma from their point of view. We have said that I've said that they can't fail to pay for the promises they've made for fear of losing their careers, and they cannot fail to pay interest on their debt, although perhaps they can figure out a way to keep interest rates down. We'll come back to that probably next time. But what about the cash sources side of this format? Can they raise taxes in order to close the cash flow gap? Let's consider that. Let's consider taxes. The problem with that idea is that for 75 years, tax receipts as a percentage of US GDP have been pretty consistent at just under 20% of GDP. Higher tax rates do not necessarily result in higher tax receipts because tax rates affect tax revenue in two ways. One is arithmetic and one is economic. If tax rates get too high, people will just, produce less taxable income through a variety of means. So what tax rate then will get the maximum tax revenue? A zero tax rate obviously yields zero tax revenue. And a 100% tax rate also yields zero revenue because people just stop working when they can't keep any of the money that they've earned. So somewhere in between 0 and 100% is the theoretical optimum tax rate that's going to earn the government its maximum revenue. That theoretical tax rate is at the top of this little curve shown here. And it's called this curve called the Laffer Curve, named after the economist Art Laffer. Now, we do have historical examples of this principle in action working, such as when the UK reduced tax rates in the 1980s, and a few years later, tax receipts as a percentage of GDP went way up. It also happened in the aftermath of when Berlin Wall fell and the Eastern European countries introduced, after a recovery period, they introduced low tax rates and increased their tax revenue tremendously. Now, Art Laffer himself, I should say, does not take credit for this idea. It's actually been known for many centuries. However, he did make the idea famous at a 1974 meeting with Donald Rumsfeld and Dick Cheney. He drew the curve on a napkin to make a point, and an attending economist named Jude Wanniski started calling it the Laffer Curve. I have actually met Art Laffer on several occasions. I had breakfast with him about 6 or 7 years ago, and he mentioned at the time that he was consulting with a Middle Eastern government to help them maximize tax revenue. So, his expertise is in demand. He really is a true tax expert. Here's the main takeaway, I guess, from this idea is not that you can know exactly the optimal tax rate from the politician's point of view. The point is that you cannot just arbitrarily raise the tax rate and generate more tax revenue. As this chart shows, for the last 75 years or so, tax revenue as a percentage of US GDP has stayed constant, whether the top tax rate is 90%, 60%, or 40%. So we're not going to raise much tax revenue by simply raising the tax rate. Therefore, the easiest way to increase tax revenue is increase nominal GDP, because 20% or 19% of a higher GDP gives you more tax revenue. So keep that little interesting fact in mind. Okay, how about the government's other source of revenue, which would be borrowing? Further government borrowing is limited by rising interest costs because debt rises as you pay more interest. This chart shows that interest costs have been rising rapidly as the debt increases. However, interest costs as a percentage of GDP, shown here, doesn't really look too bad in recent years, because until 2023, interest rates were declining even as total debt went way up. So rising debt was offset by declining interest rates, shown here, keeping total interest costs pretty flat. Now, this was a unique circumstance in a period of constantly falling interest rates, 40 years of almost constant falling in interest rates. People have not paid enough attention to this point. The government got lucky, you might say, because they were able to fund a lot of debt with cheap interest. But now the game of refinancing federal debt at ever lower interest rates is over. This chart here shows that interest rates on treasuries have been plummeting for 40 years, enabling this huge accumulation of debt. I mean, if you thought interest rates would stay near zero forever, why wouldn't you borrow, till the cows come home? But as you see on the far right of this chart, way over here, interest rates have broken the downward trend and are now rising rapidly, and they're unlikely to return to the near zero levels of the past few years. Now, here is a combination chart that I built from Fed data that illustrates the problem. The blue line there, red on the left axis, is annual government tax receipts. Okay. The red line, also on the left axis, is the total annual interest cost on that debt, on the debt. The green line on the right axis is interest rates. And that bottomed, as you see, in 2020, when the 10-year bottomed at something like 35 basis points. Okay. In interest. Now, look at the time of rapidly growing debt, which was also the time of rapidly growing tax revenues. And you will see that the interest cost is rising slowly, even as receipts were going way up because of inflation, inflated profits, and inflated capital gains. And that is because the interest went up very slowly because the Treasury debt, both old and new, is being refinanced at lower interest rates. And so what do you think? This looks pretty favorable right here. What do you think has to happen to that interest cost as the existing Treasury debt rolls over and is refinanced at higher rates? Obviously, interest costs have to grow very rapidly. The red line, in other words, is programmed to shoot up very rapidly because it's going to follow that green line, which is shooting up very rapidly. So right now, today, interest costs are a little over 3% of GDP. And the Congressional Budget Office projects that by 2050, 27 years from now, interest costs are going to rise to about 11.5% of GDP. Now, those projections assume only very modest increases in interest rates. But if tax receipts are limited to 20% of GDP, which I think is likely, that means interest costs will be almost 60% of tax receipts, much higher than they are now. So that's not a good look for someone who would normally, want to lend money to the U.S. Treasury Department. But I submit that long before we get to that point, investors are going to become reluctant to buy Treasury bonds unless they're compensated by much higher interest rates. But that would put even more pressure on the government's budget. There's already pressure on the Treasury market as the big foreign buyers of Treasuries like China and Japan are drawing down their Treasury holdings. They are not adding to their Treasury positions. So the question becomes, who is going to buy Treasury debt even as we need more and more funding? So, thinking of the cash flow formula that I showed you, the format, and seeing what components of it can be manipulated, it appears to me that the government, in order to be able to keep borrowing, is going to have to raise tax revenues by increasing GDP while simultaneously holding interest rates as low as possible. Increasing GDP means increasing consumer prices, because it's rising prices, the items actually in the consumer price index, that determine the increase in nominal GDP. In other words, it's in the government's strong interest to pump up GDP through inflation while suppressing interest rates to a level well below the annual increase in the consumer price index. So I am saying, to fund itself, the government is going to have to adopt a combination of high inflation and low interest rates. And this is what the government, I think, is going to need to do. And this combination is known among economists as financial repression. And I think it's here already. It's here to some degree, and we're going to see more of it, perhaps for many years. Now, next session, let's see how we're doing on time here. Yeah, about good. About right. Next session, we'll go into detail on exactly what a government policy of financial repression consists of. That is, what kinds of economic policies, legislation, and regulatory action they can do to implement financial repression. If you want to think of it in personal terms, just consider that if inflation is rising at 10% and all you can earn on your savings is 5%, then you, the saver, are the one being financially repressed. Financial repression is an application of the principle that savers are punished by inflation because you have to invest your money at a fixed rate and your money gets paid back in a currency that buys less than it did when you invested. So you get a negative real rate of return on your savings. You make up for the loss in purchasing power by either working more to earn more or by reducing your standard of living. That's a concrete example of financial repression. And as I say, that's what I think is coming. Okay, we'll get into, like I said, next week or two weeks from now, how I think government can implement that program of financial repression. But I gave you a lot to take in today. I hope it wasn't too much. So before we close, I want to just recap, maybe in a few bullet points. So first, we saw that the U.S. federal spending is huge. It's quickly growing out of control. Government spending increases are baked into the future. So government spending it'll have to continue to increase, I think. Now, this increased spending has to be funded by increasing taxes and increased borrowing, but rising interest rates increased interest costs, and that limits the government's ability to borrow. So the fix will be to pump up tax revenues while keeping interest costs as low as possible. Tax revenues are the only real source of income that you can go to approach this problem. But tax revenues will have to be increased by inflating GDP, that is, by inflating consumer prices. And interest rates, of course, have to be suppressed. So that's financial repression coming. So let's talk next time about how government will be able to both pump up GDP by using its monetary levers and repressing repressing interest rates, mostly through its regulatory levers. All right. Now, before I ask for final questions, I do want to mention one thing. Here's my final, slide here. The usual information. You can find me at Substack. I subscribe for free. I'm on Twitter, mostly, and I'm on LinkedIn. But I ran across a very good video recently. Actually, it was recommended to me by my friend John, and it's called "Mommy, Where Does Money Come From?" by a gentleman named John Titus on YouTube. This goes back to 2019. I had never seen it before. And the main recommendation on this is to Professor Titus does a very good job of explaining in simple terms how Richard Werner proved empirically and inductively that money creation is pure credit creation. That when a bank makes a loan, the only thing that happens, it didn't have to use a deposit. The only thing that happens is that the balance sheet expands by the amount of the loan and by a bank deposit. And he proves it quite definitively. Werner's paper is not that hard to read, but Titus in this video really makes it very understandable, and I commend him for that. Now, I don't know anything much more about John Titus. I'm just saying that this video in itself is very, very useful if you're interested in money creation. I found it very good. All right. Daniel, I'm still not, probably my own fault. I'm not, let me see if I can see chats here. Maybe I have to stop share and then look at chats. You have any chat? Let me look here. Oh, there we are. Super chats. Philosophical Zombie Hunter, $5. Thank you, Zombie. The UK's National Health Service, he says, is in trouble. There isn't any money available, and the UK cannot borrow money to save it. Will an end to borrowing mean small government? Oh, don't I wish an end to borrowing would mean small government? No. No, government is not going to shrink. And I tried to really make that point. UK politicians are, in this respect, are no different from American ones. They are not going to let the market correct itself and return to sound money. No, they are going to continue to spend and keep promises and attract voters until voters understand this, which they are nowhere near doing. So no, unfortunately, I think the UK government is in the same position as the US government, and the US government is going to want high inflation, paying these debts in depreciated dollars, and trying to address their debts and their spending in that way. And P. Eddie for $5, who says, thanks for the information, Mr. Brown. Well, you're very welcome. So if you can, if you want to engage me on Substack and ask questions there, I'd welcome that. And with that, you have anything else for me, Daniel?
We have a last minute super chat from Kirk. Thank you so much. He
Great.
says, thank you, Hard Money Jim.
All right. Thank you, Kirk. I just see that pop up on my chat. I'm going to try to get more technologically astute and maybe watch the YouTube presentation and so I can see your real-time chats as I speak. Not quite there yet, but you know, old dogs, new tricks, and all that. All right, thanks everybody. I'll see you in 2 weeks. Take care. Be well. Thanks for watching.